A country's sources of financing are vital to its functioning and economic development. Governments need funds to cover a variety of expenses, from national defense to the provision of basic public services. Among the main sources of financing are taxes, which are compulsory for citizens and companies and provide constant income to the government. In addition, profits generated by public enterprises contribute to state revenues, as do the sale of natural resources such as oil, gas, or minerals. Another common avenue for obtaining financing is the issuance of public debt. Through the issuance of bonds and other financial instruments, governments can raise capital from investors willing to lend money to the state in exchange for interest. However, this borrowing also carries risks, as high levels of debt may make it difficult to pay interest in the future and compromise the country's financial stability. Finally, in exceptional situations, central banks may choose to print money to finance government spending. While this measure can provide immediate liquidity, it can also lead to inflation if it is printed in excess and is not backed by an equivalent increase in economic output. Welcome back to the channel. Make sure to stay until the end of the video, where we will talk about the main reason why many countries are starting to destroy their economy. Let's begin. The issuance of public debt is a common practice in the financial management of governments around the world. It consists of the issuance of bonds or other financial instruments by the government to obtain financing, with the promise to repay the borrowed principal plus interest in the future. This practice is used to finance a variety of government operations, ranging from building infrastructure to funding social programs. Governments resort to public debt issuance for several reasons. First, it can be an efficient way to raise funds for long-term projects without raising taxes immediately. Instead of requiring higher tax payments from citizens in the present, the government can issue bonds and spread the cost of the project over time, making future citizens contribute to the payment. In addition, issuing public debt can provide the government with access to additional capital when tax revenues are insufficient to cover expenditures. This is especially relevant in times of economic recession or financial crisis, when government revenues may decline due to reduced economic activity and increased unemployment. Government bonds are considered safe investments by many investors, as they are backed by the credit and tax collection capacity of the issuing government. Therefore, issuing government debt can also be an attractive way for investors to diversify their portfolios and earn income through interest payments. However, issuing government debt carries certain risks. An excessive level of borrowing can lead to higher interest costs for the government, which in turn can put pressure on public finances and limit the government's ability to finance other programs and services. In addition, high public debt can negatively affect the country's credit rating, which could result in higher borrowing costs and greater difficulty in obtaining financing in the future. The COVID-19 pandemic led to a further reduction in interest rates and a massive increase in government spending. Measuring government debt is critical to understanding a country's financial health and its ability to meet its financial obligations. One of the most commonly used indicators to measure public debt is the ratio of public debt to gross domestic product, GDP. GDP represents the total value of all goods and services produced within a country during a specific period, usually 1 year. On the other hand, public debt is the total amount of money that a government has borrowed and has not yet repaid. Comparing public debt to GDP provides an indicator that reflects a country's ability to repay its debt in relation to the size of its economy. The basic formula for calculating this ratio is simple: public debt divided by GDP multiplied by 100 to express the result as a percentage. The higher this percentage, the higher the debt burden relative to the country's economy. This indicator provides crucial information on the sustainability of a country's public debt. A high level of debt compared to GDP may indicate that the country is having difficulty managing its finances and could be at risk of defaulting on its debt in the future. However, it is important to keep in mind that the public debt to GDP ratio is not the only factor to consider when assessing a country's financial health. Other factors, such as tax collection capacity, economic growth, Inflation and international financial market conditions can also influence a country's ability to manage its debt. Public indebtedness in different countries provides valuable insight into how nations manage their financial obligations and how these affect their economies. For example, the United States, one of the world's largest and most stable economies, has accumulated significant public debt over the years, but has managed to finance it at relatively low interest rates due to its global position. Greece, on the other hand, was plunged into a sovereign debt crisis in 2009, which led it to require multiple financial bailouts by the European Union and the International Monetary Fund. Although it has implemented reforms, Greece remains one of the most indebted countries in the Eurozone. Finally, Japan faces one of the largest public debts relative to its GDP. Although it has managed to finance its debt at low rates due to domestic demand for bonds and its low credit risk, its high indebtedness raises concerns about its long-term sustainability, especially given its declining demographics and economic stagnation. The impact of a high public debt on a country is significant and encompasses several aspects. First, interest payments on that debt can become a considerable financial burden for the government, absorbing a considerable portion of its tax revenues. This can limit the resources available to invest in essential public services, such as education, health, and infrastructure, which negatively affects the quality of life of citizens and the country's economic competitiveness. Another negative effect is the risk of investors losing confidence in the country's ability to repay its debt. This could lead to a rise in interest rates, which would further increase the cost of borrowing and make debt management more difficult. In extreme cases, a sovereign debt crisis could result in default and have devastating consequences for the national economy and global financial stability. A country's excessive indebtedness can manifest itself in two different ways, depending on the country's ability to manage its debt. First, there is the scenario in which a country is indebted but can still be considered solvent. High interest rates can restrict the government's ability to pursue countercyclical economic policies or respond effectively to economic shocks. Second, there is the more serious situation where a country is unable to service its debt. In this case, the country faces significant financial difficulties that may trigger a sovereign debt crisis. The government is forced to negotiate with its creditors to restructure the debt, which may involve extending payment terms or reducing the total amount owed. In extreme situations, the country could declare bankruptcy, with devastating consequences for its economy and its reputation in international financial markets. Ultimately, it is the citizens who end up paying for the debt through higher taxes, cuts in public services, or inflation due to money printing. It is essential to recognize the importance of fiscal responsibility to avoid future economic problems. Governments must be prudent in incurring debt and ensure that it is sustainable over the long term. This involves setting appropriate fiscal policies, controlling public spending, and finding ways to reduce existing debt. In addition, it is crucial that citizens are informed about the implications of excessive debt and actively participate in the debate about their government's financial and fiscal decisions. This can include demanding transparency in debt management, advocating responsible austerity measures, and pushing for greater accountability of political leaders. Thank you very much for staying until the end of the video, my friend, and if you liked the video, give it a thumbs up and subscribe to make sure you don't miss any of my videos.